Okay, can you hear me up the back? Yeah. Can you hear me? Thank you. Welcome back. I hope you enjoyed your holiday. Week 9, I'm going to talk about the financial crisis. The left, you can see over here, financial crises aren't different. There's a history here of 8 centuries of financial folly by Carmen Reinhart and Kenneth Rogoff. They document that financial crises are pretty much the same kind of thing. They happen as a surprise. People think it's going to be different this time, and it's not. And usually the causes are the same. So in some senses, the story that I'm going to tell you is a fairly familiar one. It's a common one. At least it's the same thing, iteration that's been going on for at least 8 centuries. But there's also another aspect to this financial crisis that I want to focus on that I think is interesting, and this is the financial crisis of 2009, which is 10 years ago now, and it's remarkable that we're talking about this, is that it dealt a severe blow to confidence. In terms of intellectual history, this was a milestone event on the order of equivalence in terms of intellectual history of something like, say, a major war, like Vietnam or possibly World War II or something like that. That's the extent to which this dealt a blow to one version, one view of how the world should operate. The notion of slapped by the invisible hand, that refers to a saying by Adam Smith. Adam Smith said famously in 1776 that every person is led, the way that society is organized, by pursuing their own self-interest. They are led inevitably to maximize social welfare. So by everyone pursuing, in other words, acting in their own self-interest, you could argue selfishly, they are now furthering social welfare. And this concept became known as the invisible hand. You don't need a central market or central authority to direct the economy, because this invisible hand will direct everything. And that's been the basis for the economic settings, policy, for much of the past 75 years. So it came as a huge surprise then when we had the financial crisis, and this is what the reference is: we were slapped in the face by the invisible hand, which we expected to be a friendly hand, turned out to be a mean hand on the one hand. And to give you an extent of this blow to the confidence, we have, and I'm going to talk a bit more about this idea from Gary Gorton. He says, prior to the financial crisis, economists, particularly in the West, and particularly North American economists in the US, they thought they'd solved it all. They basically thought it's sure that financial crises happened, but they happened somewhere else where the people, for some reason, hadn't got it right. So now when someone has an accident, you sort of think, oh, they had an accident, oh, that's really bad, that could happen to me. No, but they must have made some kind of mistake. They were inattentive or something. If I was in that situation, that wouldn't have happened to me. So that's how you kind of kid yourself that you're immune to an accident. In pretty much the same way, the US, the economists thought, if there's an Asian financial crisis of 1998, it's because somehow the policy settings were wrong over there. If you had the Mexican crisis, well, it's always Mexico. If it's Greece, then you know, well, this is what else could you expect, kind of thing. But this kind of thing, this could never happen in a well-run economy such as ours. And then it did. The inconceivable have happened. How could economists, himself included, have been so wrong? To give you an extent of the hubris, and you know the saying, pride comes before a fall, I'll show you what people were saying. Nobel laureate in economics, Robert Lucas, and then this is in 2003 in the presidential address. He says, my thesis in this lecture is that macroeconomics in this original sense has succeeded. We know we've won in terms of economics, in terms of solving the problems of depression. There's nothing to resolve. We've succeeded. Let's plant the flag here and declare victory. Similarly, Glenn Hubbard, the Dean of Columbia Business School, Chairman of the Council of Economic Advisors under President George Bush, said, the US financial system stands as a beacon for the possibility of a virtuous relationship between capital markets and sustainable economic growth. In other words, the rest of the world should come over and start following us now. And this was in the period after the collapse of the Soviet Union, when they thought, well, that just proves it, right? The Soviet Union collapsed. It was a communist system. Our system is the best. So when it finally happened, you had this sense of shock amongst economists, prominent commentators, including people like Alan Greenspan, saying, we thought that people would act in their own self-interest, and that's not a reasonable assumption, because part of the crisis was this lending, poor loans that became bad, to people. So people made loans, banks made loans to people who couldn't pay them back. Now that happens a bit, but this happened in such a big scale, and in hindsight it looked like this was so bad, you wonder what the banks were thinking when they made those loans. So, and normally, and it's not a bad assumption, in your own self-interest, you wouldn't lend to someone who you know couldn't repay you, because that's what your profit is. So he makes the point that, well, we thought these lending institutions knew what they were doing. How could they have got it so catastrophically wrong? That's the... So, to go back to talk about this, there's a sense then maybe we should rethink this notion of the invisible hand. And here, the invisible hand comes from this book, the origins of it come from The Nature and the Causes of Wealth of Nations in 1776. This is like, in terms of economics, you can think of it as the Bible of economists. It's the original text. And probably the most quoted passage from this, it's a very thick book, but the most quoted passage is this one over here. Every individual, by directing his industry, in other words, working in a manner as so that he can profit themselves, they're intending only to benefit themselves, but will this, as in many other cases, be led by an invisible hand to promote an end which is not his immediate interest? In other words, when you go to Coles, you're buying and you're selling, Coles is looking after its profit, but then in providing that service, it's benefiting yourself from that voluntary transaction. So he says, by allowing people liberty to do that, to pursue what's in their own self-interest, for people to engage in transactions voluntarily, everyone is better off. Because when you buy and sell something, if you're buying something, you must want it more than what you're giving up, and the other party must be wanting what you have, giving them more. So everyone's utility is increased in that way. So then we have, however, recently we've come to this sense that things aren't working as well. The banks, in pursuing their own self-interest, seem to be harming those people that they're intending to assist. So you have here Adam Smith from 1776 with his notion of this invisible hand, people acting in their own self-interest, versus Commissioner Kenneth Hayne, former federal court judge, High Court of Australia, saying, no, the banks have behaved badly. And what we're saying over here is, and so this is as a result of his inquiry into the banking, superannuation, financial services industry, and what they're working out is whether they were charged with setting up to see whether the financial institutions were engaging in any misconduct, and whether any conduct, practices, or behaviour of business activities of those entities fell below community standards and expectations. So having spent hundreds of millions of dollars, or at least, well, tens of millions of dollars at least, lots of witnesses, he came up with 4 observations. And one of them was, in almost every case, he says, the conduct in issue was driven not by the relevant pursuits of profit, but also by individuals' pursuit of gain. Now, a couple of things. One is, before this commission was set up, pretty much all of the pundits, economic experts, and I probably would have fallen into this camp a little bit myself, would have had some sympathy, would have thought, there's really no need for this Royal Commission. Sure, we'll uncover some instances of bad behaviour, but that'll be limited in the minority. That won't be representative of the bank's behaviour. It turns out that the scale of the misconduct was such that people were shocked. And so you can see, if you go to the press, you'll find a litany of people sort of confessing, says, no, it's really wrong, that really the system wasn't working as we expected it to. But you can see now the tension here. There's a tension between what we think of as people acting in their own self-interest and this notion that maybe there ought to be some form of regulation to control that kind of behaviour. It says, entities, individuals acted in the way they did because they could. Consumers often dealt with the financial services entity through an intermediary. But, and he goes on to say, those intermediaries weren't acting in the interests of the consumers. Now, because if that's a bad thing in itself, that's bad news for the financial services, because the financial services sector is all about being an intermediary. If you're in the financial services sector, you're a middleman. So the issue here isn't the fact that they're an intermediary, but they weren't acting, the interests of the intermediaries weren't aligned with that of the customers, and that seemed to be a cause of concern. And the entities that broke the law were not properly held to account. So the point here is that I've set up this tension, and that's because this passage by Adam Smith is typically the one that's most often quoted, but he had a keen appreciation of human conduct and commercial affairs, and he also recognized that, in fact, there ought to be some kind of regulation. It can't be a free-for-all. There has to be a role for the government for regulation to restrain the conduct. And he gave an example over here. He points out that, in general, to restrain private people, to stop people from engaging in a free and voluntary exchange between themselves when both parties are willing to exchange is a bad thing. It goes against natural liberty. But there are situations when that occurs that, in order to prevent, when that goes wrong, when that deal goes wrong, to prevent the bad effects from extending beyond those two people involved, we need to have some regulations to limit that, some kinds of voluntary trade. So he said such regulations may no doubt be considered, in some instances, a violation of natural liberty. And he said, in general, that's a bad thing. But when two people are acting voluntarily and there are consequences that occur that affect other people beyond them, negative consequences, then he says there's a proper role for government. And he says, and he draws an analogy between building a party wall. A party wall is a kind of a fire hazard, a fire block. So you build in a building, back in the 18th century when Adam Smith was around, fires were a frequent cause of death, of loss of property as well. And so they used to build walls so that when a fire broke out in one place, it would be prevented from hitting the other buildings. So he says that's exactly the same kind of thing, analogy we should have with banking regulations. We should stop the contagion effect from a bad deal affecting everyone else. So in that case, it can be appropriate to regulate the free exchange between two people. So the question now becomes, where do we draw the line? So how much regulation is appropriate? And that's something that's actually a very interesting question, which we won't have time to go into. But I just want to point out this is something that will occupy you for the next for your working lives. We'll also see a tension then between what we recognize over here. For some reason, Australia calls itself the West, but the West, in terms of geographically, is Western Europe and the US. And the other country, that's the other economy that's proving a challenge, and that is China. So we see here where we have China, an ostensibly communist country, then essentially competing on this level, but not effectively having a very active government directing the show. So, this came home most forcefully when I read an article in the New York Times on the 18th of, there's a series of them, they wrote a series of 5 articles. And the first article there is called The Land That Failed to Fail. And why they refer to this is that in the past, back in 1978, when China started on its path of going to a market economy, they still insisted on having a whole lot of government direction of the economy, and people said, no, this will never work. You have got too much government controlling the economy. But it seems to be doing okay. And so the point of this article was the West was sure that the Chinese approach would not work. It just had to wait, and saying it's still waiting. So the question is, so you'll see there'll be an intellectual struggle trying to justify which one, because it's not easy to work out what's the pros and cons of each method. So that's an interesting element about the financial crisis, which I'd love to spend more time on, but I can't justify it on the basis of other things you need to know. So back to the crisis. Why learn about this? It shows the link between finance and the macroeconomy. It's relevant to risk assessment and security analysis. So people will often say, do we have another global financial crisis? Should we be worried about this? So there's one reason to learn the lessons from the global financial crisis. There's lots of explanations. And also the policy responses are highly politicized. So people have come up with responses. In fact, there's a giant bailout of the banks, which went against the grain. So a lot of commentators on the sidelines who weren't responsible said, no, we shouldn't bail them out, but conveniently ignoring the consequences that would happen if they weren't bailed out. You've got this bank regulation, the US Sarbanes-Oxley Act. So again, we have a lot of commentators saying the US has gone too far in having these regulations. The GFC partly contributed as well to the Royal Commission into the bank's behaviour in Australia. So another thing I want to point out, though, is the financial parallels from the events that led to World War I. So we're at the end of in 2019, we're about 100 years from the Big World War, which was the first Big World War. And there was a crisis back then in 1914, a financial crisis. That tends to be overshadowed. People don't pay as much attention to it compared to, naturally, the bigger event of World War I. But I want to point out some parallels between these two things. At this period, you had the same thing. You had a society, the West, if you call it if you can call it that as in terms of one society, at the dominating the world. So at the peak of its power came the World War I, which then shattered that power and led to the decrease in the domination of the West. To give you an extent of that, and this is a remarkable photo, you have this photograph taken at the funeral of Edward VII of Windsor in 1910. And these are the kings and emperors of Europe. But not just of Europe, of effectively the world, because them and their colonies dominated the world. What's more remarkable about this is they're all related. Every single one of these people is related. So you had one family ruling over the whole world, effectively. King Haakon of Norway, Tsar Ferdinand of Bulgaria, King Manuel of Portugal, Kaiser Wilhelm of the German Empire, King George of Greece, King Albert of Belgium, King Alfonso of Spain, King Emperor George V of the United Kingdom, and King Frederick of Denmark. And missing from there, because although it was his cousin, he wasn't very fond of him, that's Tsar Nicholas of Russia. So he didn't come along. This person, you might recognize her, was related to all of them, and that's Queen Victoria. Her 3 grandchildren were 2 or 3 of the major players in the World War. That's the world that her relatives, her grandchildren ruled over. Pretty much all of it. And 3 of them, just 3 of them, were Nicholas of Germany, King George, Emperor of England, and Nicholas of the Emperor of Russia, the Emperor of England, and the Emperor of Germany, Wilhelm. It's a bit like Game of Thrones. They went to war. This is the Queen looking at... I've not seen Game of Thrones myself, but I'm told it's quite popular, so and here she's having a look. But you could look at her own history, because... So, what's the point of that? The point being that often the enemy, the biggest danger, doesn't come from the outside. It comes from within. And typically we tend to look at the danger. So when, at the time of this, the global politics was not about the war between them, because that seemed unlikely. After all, they were cousins, and they were all Europeans. Why would they get into fight? But they were all concerned about the other people. But it turned out they should have been concerned internally. So you have this, the danger is often within rather than without, and I compare this with The Clash of Civilizations by Samuel Huntington. So he's got this history that there is a big clash that's coming between the Muslims and Christian civilizations. But actually, if you look historically, that hasn't been as big a clash as the clash within Western Europe itself. And so similar, when the politics of the US, when they talk about the economic system, they were talking about, the threat from the Soviet Union or China. They were not thinking about the threat from within themselves. So you had the Lehman Brothers, General Motors, and the US financial system at the peak of their powers, and then came the financial and the crash. Both events were preceded by an unusually long period of calm. There's a great peace in Europe between 1870 to 1914. Over here, there was a great moderation between 1987 to 2007 when there was no major recessions, no major depressions. And then the collapse came, which was a huge blow to self-confidence. So the collapse often occurs when it's least expected. Individuals' incentives make them heedless of the broader consequences of their actions. This is why people talk about this. Some histories of this talk about the sleepwalkers, how Europe went to war, because they weren't concerned about the consequences of their actions. And then the fact that things are different, people seem to think it's different this time, so we don't have to worry about it. We've got this under control. And the trigger for the collapse is hard to predict. So what I'm going to provide now is an explanation of this by Robert Gorton. He's going to explain why is it that this really weird behavior occurred. Why is it the case that we had companies, financial institutions, staffed by the best and brightest, going to the same kind of courses that you're doing, coming out and making these loans that seem so very odd? You can say they were behaving irrationally, but then that's not an explanation at all. So he's going to untangle that and point out why people acting in response to the incentives that they faced came up with this suboptimal outcome, as it were. He's really interesting. He's been a Marxist economist, a student of Chinese literature, union organizer, cab driver. He also issued some of those bonds himself as part of a company. And then when they collapsed, he turned and became an academic and became quite a successful academic. So he says, his thesis is that economists misunderstand financial crisis, what they are, why they occur, why we didn't have one in the United States. And the reason why provided his background before is partly because I think his background allowed him to see the fact that he wasn't trained in the classical economics way, gave him some freedom to explore other explanations which other economists might have been able to see as clearly. But he says, what are the origins of misunderstanding? And this is the interesting bit. He says, this is a question about the epistemology of economics, how economics produces knowledge. That's our subject. Now, that might seem a bit esoteric. Let me show you what I mean by this. The insight that he's developed, along with Bengt Holmström, is that some markets work better. That is, they are more liquid. We have more transactions when people are less informed. Now, that's counterintuitive. Normally, you think to invest in the market, you need information. The more information you are, the more confident you are about investing. And that's not an unreasonable assumption. But he's saying there are in certain limited situations, by being less informed, it promotes trading. And one example that you can relate to quite straightforwardly is the way De Beers sells wholesale diamonds. Now, the thing about diamonds is it's hard to tell a real diamond from a fake diamond. It's also hard to tell the quality of a good diamond from a mediocre diamond. Just looking at it, you can't tell. You need to have a magnifying glass. You need to be an expert. You need to read the signs. To analyze each one takes a long time. So if you're buying and selling and you're looking at the property of each diamond, and each diamond is different, it slows down the trade a lot. Exchange will only be able to take place between people who are really well informed. So this is why you can have a monopoly like De Beers. Lots of people can unearth diamonds, but it's only De Beers that has a monopoly. And why does De Beers have a monopoly? Because De Beers has a method to facilitate the transactions. What they do is they sell diamonds in a packet, and they certify, they say, we've got our people, they've looked at this, and the quality of the packets are roughly the same. You can't look at what's in the packet. you can simply take our word for it and quote us a price, and we'll sell the whole packet to you. De Beers has been in this game for tens of years, possibly even 100 years, I don't know. But they rely on their reputation. So people think, okay, if De Beers, if they might sell us a dud, but then they've got their reputation, they'll damage their reputation. So we'll rely on them. We won't worry about being informed. So in this case, De Beers facilitates ignorance. Not being able to peer inside facilitates trades because people simply work on the basis of trust. They have faith. And I'll come back to that word, faith, again. So I'm going to draw an analogy between this and this isn't just me making this up, but this is the subject of a presidential address. I'll put the picture up here, though, because I want to draw an analogy to the original tale. You might have, some of you will be familiar with the biblical story. So the first book in the Bible, the book of Genesis, talks about God created the world in 7 days, and 6 days, rested on the seventh day. And then he created Adam, and then created Eve, and they were in the Garden of Eden, where the garden was great. But he did say, there's a tree there. And you might wonder this, because I wonder what's the point of this. This seems such an odd kind of thing to begin a religious text with. But that's the first story in the Bible. There's this tree of knowledge. Don't eat from that. So it's a kind of a weird thing. What's wrong with eating from the tree of knowledge? And then, but they think they're pretty happy. And then Eve gets tempted by the serpent, eats from the tree of knowledge, and bad things happen. They get banished. They look at themselves, they realize they're naked. And they ask for some clothing. And then it goes on. So, what I'm going to point out is a parallel with the financial system. I'm going to say this system worked really well when people were ignorant and they accepted things on faith, and then there came something similar to the serpent, which led the scales to fall from their eyes. They saw themselves, they were naked, and the market crashed. So myths, which are a point over here, that myths are important. And here I'll just remind you that UWA's motto is actually seek wisdom. It's not cram your head with a whole lot of facts. It's actually seeking wisdom. And wisdom isn't the same thing. It's knowing, it's having judgment, knowing when to act, what to do. And so one of these things is sometimes it's wiser to propagate a myth than to motivate a search for information. Okay, so let's go back to what is a financial crisis and why was a financial crisis global in scale. So you have had a whole lot of people in American bankers doing the wrong thing, but why should it affect us in Australia? So a crisis is when they have a collapse in the value of financial assets that leads to a severe shortage of credit. The world runs on credit. You try thinking about just about any transaction you have, unless you have the cash in hand, most of your transactions will be with credit. So if a credit shortage means that business cannot get the finance for their operations, the demand drops and the economy slows down or reverses growth. So what leads to a financial crisis is two things. One is a liquidity crisis or a solvency crisis. So why? That's the first thing. The second thing, why was the crisis global? It was global because 40 to 90% of 1 year's output, the equivalent of 50,000 to 120,000 for every US household, was foregone due to the 2007 and 2009 recession. You want to know how much a trillion is? I'll help you visualize this. So imagine $100 bills and you're adding them up. If you pile them in $100 bills, the stack would reach 1,090 kilometers high. You can go to Albany, that's 409 kilometers, and you wouldn't have $1 trillion there. So Next time you're traveling down south, think of the $100 bills stacked up all the way. So, but the loss was in the US. But it affected the whole world for two reasons. One is that the US back then, and still now to a large extent, is the engine of the world's economy. The demand from US consumers for products from all around the world drives the economy of a whole lot of other countries. So if demand in the US falls, a lot of other countries suffer from that. And you can see that this is in 2007. These figures are out of date. China is now much bigger. India is a little bit bigger. And Americans are also a little bit bigger, but the other two, the rest of the world is catching up. But still you can see the outsized role of the US in 2007. And you can see the change in the stock market value. These are the countries that were exporting a large part to the US, and so when the demand fell, the value of the stock exchange fell. It was also the slowest crisis in 200 years. So it slows down. The people, we haven't recovered yet, and it's been a little bit of a mystery. So Greece and Italy won't regain their pre-crisis level of real GDP within the World Economic Forecast period, which stretches to 2022. In many countries, output is still well below the levels that could have prevailed had output followed its pre-crisis trend. So this was a real stoppage. The effects are being felt right now. And it's even had an effect on fertility rates and migration. So you can have a look over here. After the 2008 financial crisis, fertility rates declined in several advanced economies. When you're poorer, you have, unless you're really poor, in which case you have lots, unless you're using your kids from the age of 6 or 7 to help you economically, but usually you wait until you can support them. So you can see that in a lot of countries, people couldn't afford children, or they could afford them less, so fertility rates declined. So how did it happen? Well, so this is the proximate triggering cause. What caused the crisis was a rise in interest rates from 1% to 5.3% between 2004 to 2006. The default rates on US house mortgage loans rose to record levels, so people now began to pay a larger portion of their income, of their spare money, to paying off the house, so you don't have money to spend on anything else, so demand falls. And the impact is felt globally, because the US, as I said, is the world's largest economy. US domestic debt levels were high. The lenders to the US were spread across the world. So part of the US debt was being financed, and this is the odd thing, was being financed by people from outside the US. So the richest country in the world was being financed by people, by savings in much poorer countries there. Now, the problem here was not so much the losses, because in the stock market crash of 2000, we had huge losses, but it didn't really affect the economy. But because people weren't sure who bore the losses, who had suffered the biggest loss, everyone thought, you might be a bad credit risk. So this quote puts it really nicely. If you have 10 bottles of water and one bottle had poison in it, you wouldn't know which one. You probably wouldn't drink out of any of the 10 bottles. Basically, that's what we have here. People weren't sure who could repay or who couldn't repay their loans. So you can see that there's another point I want to bring out here that doesn't seem to have got picked up in a lot of things, but what you see from 1991, which is where we have 8%, is that in that period, there's been a gradual decline, followed by increases, but mostly the trend is downwards. There seems to be a slowing down of the world's economic demand. And every time that's happened, the governments have responded by reducing interest rates. So what I feel that has been overlaid the financial crisis is an aggregate slowing down of demand, and that's been slowing down the world economy. And the financial crisis simply exacerbated that. But even without the crisis, I think we would probably still have had a problem. So you can see this playing out over now. The Donald Trump saying that the Fed should cut the rates and lift the economy. The US is in its 10th year of continuous economic expansion, but he's in his second year of his 4-year term, and he needs to be able to get the economy keep on booming to get re-elected. And the Federal Reserve in the US has been slowly increasing interest rates in response to the economic expansion, but he's saying, no, you should cut this. He said, which is a change from what the Republicans were saying when the Democrats were in power, because the Democrats tried the same thing and he said, no, you're being irresponsible. But clearly, times are different now. But we can see here, historically, we've got these higher levels, these interest rates, and now we are back to the last time in 1946, shortly after World War II, we're at the same level in an attempt to kickstart the economy. Okay, going back to these two key concepts that you need to understand about the financial crisis. Banking is, at bottom, a confidence game. Now, the term confidence man is generally a pejorative term. When you say you're a con man, it's short for you're a confidence man. You take someone into your confidence, and then you trick them into giving them your money, typically, and then you run off with the money. The banking, though, is similar in a good sense. What they do is they take deposits, they accept money, and they'll pay you an interest rate. They'll keep it for you, and then they'll lend it out at a high interest rate, and that's make their profits. But, so if they take in 100, they'll lend out 90. And what they're relying on here is that the people who've deposited their money don't come back all at once and ask for it at the same time. If they do, they're in trouble. So, and generally, if you've got enough experience, you can work out what the demand is for money. So the risks that they have is a liquidity crisis. That is, there's a sudden, unanticipated rush for people wanting to come and get their money out, and you don't have it because you've lent it to someone else for 30 years. They might have lent it to you deposited for 6 months, and you're expecting to get other people, but you've lent it out for 30 years. That's your business. It's maturity conversion. No. So that's a problem. That's kind of a problem that time will fix, a liquidity crisis. A solvency crisis is when you make a bad loan. You lend your money out to someone who won't pay it back. And that way, no amount of waiting will fix this problem because the money is lost forever. The problem from the bank's perspective is that they have no clear way of signaling to their depositors whether it's a liquidity crisis or a solvency crisis. So, you go to the bank, and then they say, oh, no, we don't have any money. So, what do you mean you don't have any money? I gave it to you. He says, no, we lent it to someone else. And so, but who? Well, someone. He'll pay it back. So you just wait. Can you just wait a minute? And now there are two things here. You can say, you can wait, but then you don't know whether they've lent it to someone who can't pay it back. So that causes a bank run. So liquidity crises have largely been eliminated by central banks sort of saying, we'll provide deposit insurance. If you have less than 250,000, you don't need to worry. We'll step in and reimburse you. And they'll also make a loan to resolve the mismatches. So they'll help out the bank that has a liquidity crisis, assuming that the bank is being truthful and says it's a real liquidity crisis. Working that out can be quite difficult. Yeah. So, and then the risk of the solvency crisis is reduced by regulatory oversight. So we're subject to that right now. You can see if you've been following the financial press or even the normal press, you'll see that people are finding it much more difficult to get housing loans, and that's slowing down the market. So it's slowing down the housing market because people are finding it difficult to get the financing to build. That's a result of regulatory controls. So, and that's to prevent a solvency crisis. So the banks then are subject to this extensive regulatory oversight. Now, given that these are in place, the next question then, well, we've got these systems in place, and this is part of why economists were so sure that they'd solve this problem, because they had regulations in place to solve the liquidity crisis. But the banks made bad loans on such a large scale that it overcame these restraints. And this is the paradox. The financial system the point of the financial system is allow risk to be better managed. But in this case, the development of the financial system seemed to have increased the risk on the economy. And so we had this AIG Lehman shocks hitting the world market. This is the day in September 14, 2008, when Lehman Brothers went bankrupt. So to explain this, why the banks, what happened with this bad lending, we have a couple of key building blocks, and one is the rise of shadow banking. Shadow banks are institutions that accept deposits and lend or invest money. Now that sounds like a bank, right? That's exactly what a bank does. They accept deposits and they invest money. But they are subject to less regulatory oversight and control. And the reason why they're subject to less oversight and control is because typically it's not retail investors. So if you're a retail, that is if you're a mum and dad or ordinary Joe Blow, you can't invest in a hedge fund, you can't invest in a private equity fund or an investment bank, because you can invest in a superannuation fund, but typically the superannuation fund is managed by an expert. And so people think, well, given that they're managing the money and these people are big investors, they can look after themselves. There's no need for us to regulate them as closely. It won't matter if they lose money because they're the bigger kind of investors. So how did shadow banking come up? So we have two kinds of investors who you need to deposit your money in safe, short-term earning interest accounts. One is the individual retail investors, so you and me kind of thing. So we're served by going to a regular bank, Westpac, NAB, or the Commonwealth, or CBA. And then you have large-scale professional money managers with tens of millions of dollars. So they need to park their money somewhere. And the capacity of the normal financial, of the regular banks is limited to be able to accept them. They can't accept this much money on a short-term basis. So because there's the regulations prevent them from taking on so much debt, for one thing. So around about 1980, there was this alternative market that developed to solve the problem of a lack of safe, short-term deposit-taking facilities. How does this work? An analogy here is like cash converters. You might have seen, hopefully you've seen the ads. So a cash converter is a business where if you want cash in a hurry, then you take something valuable of yours. It might be a Rolex watch. So the Rolex watch, let's say, is worth $1,000. You take to the bank, take to the cash converters, they'll look at it and they'll say, okay, we'll lend you $200. This way, of course, it's far less than the amount that it's worth. But by saying that, they'll say, we'll keep this as collateral. When you pay us back with interest, then you can buy back but basically you're selling it to us on a short-term basis. And then if you don't pay us back, we keep this. So you have every incentive to repay them. So the collateral is the thing. So what we do is it works in a similar way with shadow banking. Large-scale professional investors, they deposit or they sell their money to the shadow bank entities like Lehman Brothers. Lehman Brothers gives them some collateral, which could either be US Treasuries or it could be collateralized debt obligations. These are loans made to people, so mortgages. They'll say, we'll give you this mortgage. You lend us the money, we'll give you this mortgage, And then if we don't pay you back, you can keep that mortgage, and then you can get the benefit of the repayments of the mortgage. That's how it works. Okay? But the value of this, again, depends on this. People, the willingness to accept the CDOs depends on people thinking that these loans are valuable, these mortgages are valuable, that the people hold with the obligation to pay will be able to repay them. That's what's. So the deposit term is short, and the borrower with whom the money is deposited agrees to repurchase the bonds at the end of the lending period, often the next day, at a price that includes the payment of the overnight interest rate. So what does Lehman Brothers do with this money? Lehman Brothers then, it's got this money because it's borrowed it, and now it lends it out to other businesses that needs it. So it relies on being able to borrow at short-term rates to be able to lend over a longer period. It's not its own money, it's other people's money. So that's, okay, so it's got its debt. The Lehman Brothers had at times debt-to-equity ratios of 30 to 60 to 1. That's how indebted they were. They were borrowing at short term, using their collateral to invest in longer-term high-yield investments. They only had 700 billion in assets. They had 700 billion in assets, but most of that was debt financed. The 25 billion, about 3.5% in equity. So you only needed a small loss for them to be completely wiped out. So they had to borrow and repay billions of dollars to the repo market every day to remain in business. Now, you think about this. If you're borrowing billions of dollars every day, it's a bit like the diamond business. What you're offering as collateral has to be accepted by the other party. You can't afford to spend a lot of time haggling about, oh, how much is this worth? You know, because you might do this for 1 billion, but then you've got hundreds of billions that you need to borrow every single day. So this will take time. You can't afford to spend that much time. So the collateral that you offer has to be accepted on faith by the counterparties. And the counterparty have to believe that it's valuable. So if a bank has to prove his creditworthiness, he's lost it. The market grinds to halt if background checks are needed. So this is the insight that we have here. When we look at this loan, people looking at this crisis, they're thinking, when we look at these collateral debt obligations, they are very hard to value. They're really, really difficult. And so no one can possibly look through them and see what they're worth. Now, to you, normally, that looks like a bug. The fact that you can't evaluate something normally is seen as some bug. You know, not a good thing. But the point he's making is that this isn't a bug, this is a feature. If you can't analyze it, and no one else can analyze it, then we can accept it at face value. Because there's nothing to analyze. It's virtually impossible to analyze. Right? $20. I'll give it to you, and you'll give me this book or this pen. It's a bargain. Right? And the reason why, what's the name? Zed will accept this is because he believes this is worth $20. He doesn't look at it, doesn't question it. Oh, the Australian government, will they back up, or will other people? No, he knows that other people will accept it. But if I was to do this in, say, some kind of currency, say, so back in Germany in 1945 or something, would you accept the money? He said, no, it's worthless. So the point being, when a currency or a good can't be analyzed anymore, when nothing affects its value, that's when it becomes useful as a medium of exchange. So this is still valuable, put it there. The value of the collateral must be informationally insensitive. the fact that it's difficult to work out the collateral debt obligations, how much is what made it valuable. So what were the benefits here? We see here that the reason why the government's allowed this to happen is that the expansion of credit stimulates demand and economic activity. In the US, shadow bank liabilities were nearly 22 trillion, traditional bank liabilities were 14 trillion. That's new money. That's money into the system. By extending credit, they're effectively creating money. Now, given that it's creating money, it's generating wealth, there's hardly a government in the world that would have the incentives to say, oh no, we could have some kind of a crisis here. The governments were benefiting, booming economic periods. The households were thinking, this is great, there's more demand, my land prices are going up, house prices are going up, businesses benefiting from cheap credit. So there's little or no regulatory oversight allowed the shadow banking to expand credit beyond prudent levels. So there's no one had any particular strong incentives to stop this particular party. The value of its assets had only to decline to wipe out Lehman Brothers. When the subprime borrowers defaulted in large numbers, the mortgage-backed securities that Lehman Brothers were using as collateral collapsed in value. So people then said, so what's your collateral? You want to borrow from us? What's the collateral? Oh, these mortgage-backed securities. I said, no, we don't. We're not taking that anymore. So that's a great movie that illustrates this whole thing about trust is Margin Call. I saw it last year, and I highly recommend it. It's just great drama, great. Kevin Spacey is a great actor. I know some bad press he's got of late, but he's a really good actor in this. And he says, so this is this company where they've got these securities which they know are duds, and now they've got to get rid of them before the rest of the market finds out. And the CEO comes in, flies in from the UK. So in the US films, the top guy is always a villain, is from the UK, comes in. And they says, sell. Sell everything. And he says, well, if you sell, we'll ruin our reputation. He says, we'll make a bigger loss if we don't sell, so just quickly sell, and then that's it. The game is over. So the question now here is, let's look at this thing. Why was credit extended to borrowers who defaulted on a large scale? So one argument is that this is new. It's different this time. People didn't understand what was going on. We had this new system of credit default mortgages, and so that was new. But actually, this isn't particularly new. This is quite old. But let me explain what they thought was new. The thing that was supposedly new was debt securitization and subprime lending. So in this case here, we have, let me explain what debt securitization is, and then we'll go on to subprime lending. So a collateral debt obligation then is a security that generates payments out of a pool of loans, of loans made to people. And so people borrow money for a variety of reasons, for equipment, commercial real estate, or to buy mortgages. So we'll focus on mortgages because that's the biggest part of the market. So how this works, you're in Perth, there's a whole bunch of people in Perth, they want to build houses, there's not enough savings in Perth, so an investment bank, that's maybe a major US investment bank, offers a line of credit to a local bank, say Westpac, and they say to Westpac, here, we've got $300 million or $1 billion, lend it out to people. Westpac then uses the credit to, I intended to give you a break. This went over time. I'll stop here, and then we'll just come back at 4. So I'll just give you a shorter break, and then we'll... Okay, so the bank opens up this line of credit to a local bank, and then, so it's Westpac in Perth, let's say. The bank uses the credit to make the loans to the individual borrowers within the Perth region. Now, so the bank has a lot of incentives, so they get a commission from this. So what's in it for them? They get a commission of the loans. Once they've sold everything, then the loan is sold to a separate entity, a special purpose vehicle, or what's known as a pooled loan trust. So now this pooled loan trust is an entity that has a whole lot of mortgages that it owns. So it effectively has the right to receive the payments from people making the mortgages. So this is like a cash generating machine. And what they sell to investors now is the right to buy shares in this cash generating machine. The pool receives a large stream of cash from over a period of time, and then the trust sells the rights to these cash flows by issuing the securities. So you have a whole lot of people who need investments, who want to have a steady stream of income, and they buy this as security in this trust, which they then pays them a stream of income. So CDOs are securities whose collateral, that is underlying assets, is the loan that were made to the borrowers. This is easily explained in, so you can look up a couple of YouTubes. Alex, over there, Alex just came by and told me that he's seen a whole bunch of very useful YouTube lectures. He's going to send them to me. I will then send them to you. So if you want this explained, and I've seen a couple, which they are very good. So if you're finding this too fast, I'll direct you to these YouTube videos. But to explain how it works, the lender, this is the big lender, the fat cat with the money, lends it to the institution, and this is the investment banker in, say, Perth. She finds the borrowers, the people who don't have money but they want to build a house, and then they're happy, they have the money to build a house, and then they now have some mortgages which they sell into this pooled loan trust. The pooled loan trust has all this money coming in from these people as over a period of time, and it sells securities to ordinary investors. Okay? So there's an investor counting the money from the security that he's received. So the risk of the securities can be tailored to suit the risk-return profile of investors. So we have, if you want to buy a security to be super safe, you buy the first tranche, they get paid first, they offer lower returns. Mezzanine tranches get paid second, get a high return, and then subordinated equity, they get last, and they get, and so they take on the most risk, and so they offer the highest rate of return. To analyze the security, each of these, how the CDO market works, to analyze the credit worthiness, you need to do something like this. You need to analyze the value of each of the individual mortgages, and then have a look at how much money went into the trust, and then the interest and the scheduled repayment loans, and then you have to work out the interest payments and what are the rights, how the payments will be divided up amongst the people. It's horrendously complicated. So part of the point of me putting this up here is actually to show you that it's very, very difficult for you to independently analyze a collateral debt obligation. It's far too costly for an individual retail investor. In fact, even for a large company, it's far too costly to do this. So they rely on the credit rating agencies. If the credit rating agencies says that this repayment, this is worth AAA, very low risk, they think, okay, low risk, we'll accept that. They don't do their own independent rating. One problem that arose, this is working, so this is great, the market's working really well. But after a while, the people to whom to borrow who are borrowing money, there's only a limited supply of borrowers with good credit ratings. So you've used up the market. And now people think, there's no one else around with a good credit rating. And then they think, but hang on, a lot of people who have less, who we wouldn't lend to individually, if you pool their loans together, collectively, they have less risk. And we'll just charge them a higher interest rate. So bankers decided to lend to people wishing to buy houses who wouldn't qualify as a prime credit risk. So a subprime credit risk is someone who wouldn't normally qualify. It's a sub below par. That's why it's called subprime borrowers. So they're easier to assess. If they're pooled together, it's easier to assess the risk. You can work out by the law of large numbers, and then investors will get a high rate of return. So what's wrong with this scenario? I think nothing. A well-functioning credit market should work like this. High-risk projects shouldn't be cut off. They should just be paid. They're charged an appropriate rate of interest. So what's to complain about? There's nothing. If this system works well, if the people are rated appropriately with the right credit risk, and they're charged appropriate interest, then the market is working well. The crisis arose because it failed at this point over here. The bond rating agencies, who are the only people with the information and the supposed competence to be able to evaluate these loans, didn't do their jobs correctly. They gave a high credit ratings to subprime-based securities when they didn't really deserve, when they weren't justified. And this is what fooled people. People thought, well, this is where, this was the bit that seemed to be a bit irrational or unexpected. So Alan Greenspan before this was saying, where once more marginal applicants would have simply been denied credit, lenders are now able to quite efficiently judge the risk posed by the individual applicants and to price that risk appropriately. So he was thinking this market's working really well. That's why we have this boom in credit. But in fact, it wasn't working so well. Let me give you an example of credit extension, of the kind of person who got a loan. Have a read of this. Your third year finance, you're well placed to judge. His house was in foreclosure. So already he wasn't able to meet his payments. He didn't have full-time employment. He had no assets to speak of. He received the loan for $450,000. Who in their right mind gives someone a loan for $450,000 when they're already in debt, they can't repay, they have a history of not repaying, they don't have full-time employment, and they don't have any other assets? So Nathan was interviewed by Mr. Bloomberg, not the TV financial reporter, and says, would you have loaned you the money? He says, you got $450,000. Would you have given yourself the money? And Nathan Clarence replies, no, I wouldn't have loaned me the money. Nobody I know would have loaned me the money. And I like this line. He says, I know guys who are criminals who wouldn't loan me that, and they break kneecaps. The business model of the mafia and similar gangs is that they don't bother with credit checks. What they do is they rely on you to come to them for a loan, and they simply say, you want to borrow money? Sure. Can you pay it back? And you say, yep. Okay, here. But there's a self-selection. You don't pay it back, they come after you and break your kneecap. Now, they might get their jollies from breaking kneecaps, but a little bit of satisfaction, but really what they really like is their money. And so they won't lend to you if they know that you're not willing to pay. Even if they break your kneecap, you just don't have the cash. And that's how bad these kind of, the borrowers were. So what was going on there? Why did the bond rating agencies give AAA ratings to securities that were not worthy of them? Were they being irrational or rational? You could say that they were having a bubble, maybe irrational exuberance. Or if you're more cynical, though, you could think of this that said her firm's model, so one analyst, her firm's model did not capture half of the deal's risk, but it could be structured by cows and we would rate it. And this is the clue to what happened. They said, well, our profits, our bonuses are based on our profits every year. Let's generate as much business as we can, and then we'll be retired. So in the short term, we'll make bonuses. In the longer term, who cares? There's an interesting thing. So when they became sued, when the crisis occurred, they were sued because they said, well, you gave credit ratings to companies or borrowers that clearly didn't deserve them. And they said, well, this is a freedom of, in the US, you have freedom of expression. So they said, we're just exercising our right to free speech. But they said free speech was wrong. He said, yeah, well, we weren't guaranteeing that it was wrong. We're simply providing an opinion. You're paying us for our opinion. If you believed it, that's fine. But all we were providing is an opinion. We weren't providing a guarantee. What's more remarkable, it seemed to have worked. So they got away. So the problem here is that no one had an incentive. Everyone had incentives to underestimate the risk. The agents who worked on the commission to find the borrowers, they didn't care. Once they made the loan, they got their commission. The investment banks, they got a cut of the revenue to sell the securities to investment. And agencies such as Moody's and Standard & Poor's. Again, A Big Short is another great movie that you should see that explains how this market worked. This kind of thing has happened before. So people talk about this notion that this is financial innovation. It's happened 6 times between 1870 and 1940, and each time with the same consequence. The market collapsed. So there's nothing particularly new about this. But, so we get to this other point. Why wasn't the market efficient? Why did investors search, never mind the ratings, Moody's might have made this mistake, but why didn't the investors search for information to identify the CDOs that were sure to fail? That's the thing. And so this is the point about where faith was important. The CDO securities originating from the market were virtually impossible to analyze from the buyer's perspective. So retail investors had no basis, no reasonable practical way of evaluating them. And so because you couldn't assess them, they were informationally insensitive. In the same way that $1 or a $20 bill is informationally insensitive. As long as everyone else accepts it, if you can't analyze it, no one else can. And as long as they accept the value of this, it's good. So they could function as collateral and be used to extend credit as long as everyone believed they were worth what the credit agencies said they were worth. It made no sense to spend resources to analyze them individually. It also meant that even if you did spend a lot of time looking at this, how could you benefit? So, let's say you look at this dollar and you think, I really don't trust the Australian government. I'm going to spend a lot of time working out, will they really pay? How good? I mean, they've had 5 prime ministers in 7 years. There's a whole bunch of lunatic politicians. Can you really trust this? So you spend a lot of time and you find out, no, you can't. And then what? How do you profit from that? You don't. You can't. Unless you convince everyone else. So there's no easy way to profit, so no one bothered to look. As long as house prices kept going up, then the subprime CDOs were safe investments. What changed the serpent in the Garden of Eden was this ABX index. The ABX index tempted people to look. So the index was based on the value of a bundle of subprime bonds launched by dealer banks. And now you had, people said, if you know this, maybe we could bet, we could take a bet. We have a publicly observable instrument that shows the risk and value of subprime bonds, and you could bet using this knowledge. Then, when information about the value of this subprime CDOs was revealed, the market participants saw that they were naked, and they felt ashamed. They refused to accept the CDOs as collateral, and the credit market, based on subprime CDOs, collapsed. So that's what things is about faith. Sometimes it's important to maintain the faith, to accept things. If everyone else believes, things work out. Once people start having some knowledge and going, that's when the market collapses. So what's widely agreed is that when there's symmetric information about payoffs, when you and I are equally informed, then we can trade with each other. As long as we feel confident that we're informed. But what's better is that you feel you're better informed than me. That's even better. Then you want to trade to take advantage. But as long as I think, but I'm also equally better informed than you, then we both trade. We're both carried away by our overconfidence. So, but it also works if everyone's ignorant. If you think someone knows more than you, then you won't buy anything from them, because if they want to sell you, they must know something. Why do they want to sell this to you? You think, well, it must be no good. If they want to buy something from you, say, why do they want to buy this from me? If you think they know more than you. So, when there's symmetric information about payoffs, either when you're equally well informed or believe you're equally well informed, or you believe you're equally ignorant and you believe you're equally ignorant, that's when you can, you'll have a liquid market. So why is it taking so long to recover from the crisis? So this is relevant here because it's relevant to the Australian situation. So the best work on this has been done by Atif Mian and Amis Sufi, two US-based economists. And they've worked out that people were so much in debt that when they collapsed, when interest rates went up, they spent all their money paying off their house debt, and they didn't have any spare cash to buy other things, and so the economy was depressed. So in this neat graph, they showed that the recovery has been slowest in the states that had the largest decline in house prices. Why that's of concern and relevant to Australia is, you can see here, is that, and this is going way back to 2017, but he says the governor of the Reserve Bank made it clear he's worried about how consumers would react if for some reason the value of the house took a tumble. And what we've seen over here is a decline in the value of houses and an potential increase in interest rates, and that's a concern for the economy. So would people stop spending, and what sort of impact would that have on the economy? So the question then is how best to proceed. And here's another big lesson. Sometimes it's better not to pursue your advantage. In this case, it's better if the creditors now when someone borrows money from you and they agree to repay them and they don't, you can pursue them if they run into trouble or they are unable. But the point that they say is that we should maybe think about new mortgage contracts that entail risk sharing between the creditors and the borrowers. So the creditors, the banks, bear some of the risk if the borrowers run into trouble, into difficulty in repaying. This is a good. So why I'm pointing this out is because historically it's been both better for creditors and debtors to share the burden of unexpectedly high stress of debt repayments. Particularly if there's a catastrophic situation, then it's better for people to share this rather than to worry about who's got the moral high ground. This kind of situation is what's facing, to put it in a more contemporary context, you have the situation in Greece where they're avoiding default after the bailout deal, but they're facing more austerity. And now the government back then was saying, no, we're not going to pay, and because we're forcing too much hardship on the population. But then the people who lend them the money, and a lot of them are based in Germany, the German bankers are saying, well, no, you guys spent too much, you borrowed too much, you should pay up. The point of a reply to that is they're saying that the Germans are forgetting their history. So this is the London Debt Conference in February 1953. And the conference, the debt was held by Germany. And so they're saying that highly indebted, without access to capital, viewed suspiciously by creditors, that's Greece now, but that was Germany in 1953. Half the country's debts were cancelled 60 years ago this week, the foundation of the economic miracle. So rather than people carrying on saying, we won the war and that, and you guys were the baddies, with all these, let's just draw a line under that and forgive half the debt. And that laid the foundation of the economic miracle. The Germans there were getting a bit annoyed by, so they're saying the Greeks are giving us the finger for not repaying us our debt. But Benjamin Friedman here is saying, well, there's no economic ground for Germany to be the only European country in modern times to be granted official debt restructuring and relief, and certainly no moral ground either, given that they were the subject of massive debt relief. So it says, the 1953 debt conference took up the matter of Germany's unfulfilled commitments, including government debt, state and local debt, and even private debt. So they said, sure, we could press our advantage. We have the legal right and possibly even the moral right, but it wouldn't be the best outcome. It's better to forgive their debt, and it proved to be the successful method. So they're saying, well, maybe they should adopt the same thing to Greece. I pointed this out to my colleagues, and the reaction was quite interesting. A lot of them said, no, the Greeks, no, that's different. The Germans are okay, but no, the Greeks, can't rely on them. I was a bit taken aback. Anyway. But there's a good article that talks about this, mythology that blocks Greeks' progress. All right, I'll stop here. I want to point out one alternative perspective. This is the summary so far, but in the last 5 minutes, I want to think about another characterization of the financial crisis, which is it's a bubble. I don't think this is so inconsistent with the picture that I presented. But the general characterization of this is that we have a bubble, is that every bubble is different and every bubble is the same. So they're different in their manifestation, but they share the same 6 underlying characteristics. So the historian Charles Kindleberger identified this. He says there's an initial displacement that grabs attention. So what this is like Bitcoin. You have something like Bitcoin that people think, this is something new, this is something value, a machine that doesn't rely on trust, that we can see the transactions. So this is a real innovation, and people look up, they look at the potential. There's the smart money response, so people get in there early and take advantage of this, and they're the ones who benefit. And then they think, when they've taken up all the attractive positions, they think, let's bring in everyone else in. Then you talk about the Bitcoin. And now you might have had people telling, come and buy Bitcoin. And this is the channels to speculation are invented. You have the authoritative blessing. You have people saying, Bitcoin is the big thing coming. It's the wave of the future. Currencies are old-fashioned. And then you have the crash, and then you have the political fallout. So in that sense, they all have the same characteristics, but So Hyman Minsky's financial instability hypothesis says there are 3 kinds of borrowers. You have a hedge borrower, and this is the one you want to lend to. A hedge borrower can repay the interest and principal from the investment cash flows. A speculative borrower can repay the interest only from investment cash flows, and what they're hoping for is some kind of capital appreciation to be able then to make a profit. The Ponzi borrowers cannot repay interest or the principal. What they're relying is on really quick capital appreciation to be able to sell it really quickly and make a gain. So in a healthy market, you have mainly hedge borrowers, maybe some speculative borrowers, and no Ponzi borrowers. But when there's an extended period of good times, that's when the proportion of Ponzi borrowers increase. And so this is why a period of relative calm can lead to people overextending themselves and turning into Ponzi borrowers. And that's when the financial crisis occurs, when the lenders to the Ponzi borrowers become disillusioned. So I point this out because you'll often hear reference to this, so I think you should know what this is, or the Hyman-Minsky's financial instability hypothesis. All right, you can start your engines now, your mental engines, and warm up. The password is CDO. CDO, collateral debt obligations, but just CDO. Tomorrow afternoon at 5:30, we'll have James McClemens from Resource Capital Funds and two people who also work in the industry come to talk to you about your lithium assignment. It's in the Murdoch Lecture Theatre. They'll take questions. These are people who are actually investing in the industry, so I would highly recommend that you attend. And also just watch them in action. 5:30 Murdoch Lecture Theatre. So, have you not heard of this? You have heard of it. Okay. Is that replacing there? No, it's tomorrow. Yeah. All right, I'll see you tomorrow, maybe, some of you. And the rest I'll see you on Monday.